In this video, I'll be sharing a straightforward trading strategy that has been tested and shown to be highly effective. Stick around because later in the video, I'll backtest this strategy many times to prove its high success rate. So without wasting any time, let's dive right into the strategy. For this setup, we'll be using a combination of three powerful indicators: the 200 EMA, the Parabolic SAR, and the MACD. We'll start with the MACD, as it serves as our primary entry signal. For the settings, I'll keep them at their default values. Now, let's break down the three main components of the MACD indicator. First, we have the blue line, known as the MACD line. This line reacts quickly to price movements and is more sensitive to changes in momentum, making it the key focus of our strategy. Next, we have the orange line, also known as the signal line. This line responds more slowly to price movements and helps filter out market noise, making our signals more reliable. Finally, we have the histogram, which visually represents the relationship between the MACD line and the signal line. It helps us gauge momentum strength and potential trend shifts. For example, when the MACD line crosses above the signal line, the histogram turns green, indicating bullish momentum. On the other hand, when the MACD line crosses below the signal line, the histogram turns red, signaling bearish momentum. The size of the histogram bars also reflects the strength of the trend. A wider gap between the MACD line and the signal line results in longer bars, showing strong momentum, while a narrower gap leads to shorter bars, indicating weaker momentum. Technically, you can use the MACD without the histogram since the crossover of the MACD line and signal line is enough to generate signals. However, I prefer to keep the histogram displayed because there are times when it provides valuable insights into momentum strength, making it a useful addition to the strategy. Take this example. Here, we can see that the MACD line is crossing over the signal line. However, since the lines are too close together, it's difficult to clearly spot the crossover. Instead of trying to distinguish the lines, you can simply look at the color of the histogram to determine the crossover direction. A common way to trade the MACD is by going long when the MACD line crosses above the signal line and going short when it crosses below. However, for this strategy, we're adding an extra layer of confirmation to improve accuracy. That brings us to our second indicator, the Parabolic SAR. The Parabolic SAR is one of the simplest and easiest to use indicators. It does an excellent job of identifying trends in the market, helping traders determine the direction of price movements with ease. For the settings, I'll keep them at their default values as well. Right away, you'll notice that the Parabolic SAR consists of a series of small dots. Using this indicator is straightforward. The position of these dots helps us determine the direction of the trend. If the dots appear below the candlesticks, it signals an uptrend, suggesting that the market is moving higher. Conversely, if the dots are above the candlesticks, it indicates a downtrend, meaning the market is moving lower. A common approach to trading the Parabolic SAR is to go long when the dots are below the candles and go short when they are above. However, relying on this method alone tends to produce a low win rate, as the indicator can generate false signals, especially in choppy or sideways markets. As you can see on the screen, all the trades taken solely based on the dots in this scenario ended up failing. That's why, in this strategy, we're not entering trades just because the dots appear above or below the candles. Instead, we use the Parabolic SAR as an extra layer of confirmation to ensure we are trading in the direction of the overall trend. Now, let's move on to the third indicator, the 200-period exponential moving average, or 200 EMA for short. For this strategy, we'll use the 200 EMA to determine the long-term trend direction. If the price is above the 200 EMA, it signals an uptrend, so we only look for long positions. If the price is below the 200 EMA, it signals a downtrend, so we only take short positions. Now that we've covered all three indicators, let's go over how to trade the full strategy. We'll start by looking at the conditions for entering long positions. The first step in taking a long position is to confirm that the price is trading above the 200 EMA, indicating an uptrend. Next, you need to see the MACD line crossing above the signal line while the Parabolic SAR dots are positioned below the candlesticks. When these conditions align, this becomes your long entry signal. For the exit strategy, place your stop loss at the Parabolic SAR level. Set your take profit at minimal 1-to-1 risk to reward ratio. As you can see, our take profit was successfully hit on this candle right here. Shortly after, another valid entry signal appears, giving us another potential trading opportunity. Here, we have an upward crossover on the MACD while the price is above the 200 EMA, which initially looks like a potential long entry. However, notice that when the crossover happens, the Parabolic SAR is still above the candle. This is not what we want. We need the dots to be positioned below the candle for confirmation. In situations like this, we simply wait for the Parabolic SAR to move below the candle while ensuring that the MACD is still showing an upward crossover. Once this happens, we can take our long entry. For the exit strategy, place your stop loss at the Parabolic SAR. Set your take profit again at minimal 1-to-1 risk to reward ratio. As you can see, this trade also turned out to be profitable. Next, we spot another long entry right here. We have a bullish crossover on the MACD while the Parabolic SAR dots are positioned below the candle, confirming the trade setup. Once again, place the stop loss at the Parabolic SAR level. Set the profit target at a 1-to-2 risk to reward ratio. As you can see, the take profit was successfully hit on this candle right here. Let's get straight into the sum tests. For this back test, I'm going to trade the stocks of Nvidia 4 hours time frame. Finally, after testing the strategy 19 times, the results are in. And out of those 19 trades, we won a very good 91%. Our most consecutive wins are 10, and our most consecutive losses are just 1. While backtesting, I discovered a few tweaks that can help improve the win rate of this strategy. One of the most effective adjustments is limiting your stop loss. Let me explain. Normally, you set your stop loss at the Parabolic SAR. However, in some cases, like this particular trade, you can see that the dot is positioned too far from the current price. If you place your stop loss there, your risk will be too large, and if the trade gets stopped out, you'll take a big loss. To prevent this, I recommend limiting your stop loss to a maximum of 0.7%. This way, no matter how far the Parabolic SAR is, your stop loss will never exceed that threshold. However, keep in mind that this also limits your potential upside. So, whether you apply this tweak depends on your risk tolerance. Also, I only tested this strategy using one set of parameters. If you want to optimize it further, I highly recommend backtesting with different settings to see what works best for you. So, I've just shared with you a simple, high win rate strategy that you can start using right away. All I ask in return is for you to take just 2 seconds to like this video and subscribe to the channel. It's just 2 clicks, but it makes a huge difference. Also, feel free to check out my other videos for more valuable trading strategies. Thanks for watching, and I'll see you in the next video.